Let's turn back to the major indexes for now. Joining me is Doug Flynn, co-founder of Flynn Zito Capital Management. Doug, it's great to have you on the show, and investors just kind of taking a pause ahead of what's going to be a busy, potentially a market-moving week. Where do we stand in the stock market right now?
Yeah, it's almost as if the stock market is ignoring a lot of the information that we're getting. I mean, the economy is doing better than expected. And the translation of that is that the Fed may have to keep raising beyond what they've alluded to, that they're going to raise 2 more times. And that's it. So it remains to be seen exactly where they're going to, how high they're going to go and how much longer they're going to go. But right now, the market's thinking, hey, we're going to get beyond this. That's what they're going to do. They're going to do exactly what they said they're going to do. And that's all well and good unless it doesn't happen. And then you're going to see some more volatility as everybody digests the updated information.
So let's talk about that updated information, Doug. I think the stock market, despite February being a down month in the wake of that inflationary data showing pressure is still persisting as the data came in for January. What's your outlook in terms of how long these rate hikes will need to last, and thus what could be in store for investors these next few months?
It's funny. I've been doing this for a little while, and I've never seen so many differing opinions on what's going to happen. And, you have a lot of positives. You have the jobs report, which you just alluded to. You've got the unemployment rate at the lowest point since the 60s. You've got retail sales up. I mean, you've got a lot coming from the services sector. There's a lot of negatives out there, too. You've got Americans now are falling behind on their car payments for the first time in a while. You've got corporate earnings, which are really weak. Now, they're doing a good job of coming out with really low expectations. But when you strip that away, corporate earnings are weak. So, recession fears are rising, and that's on the horizon. So it seems like inflation is going to be with us higher for longer. And it's going to take them a while to get to their stated 2% goal. I don't know, most people don't realize that the 50-year average for inflation is 4%. So for me, we first got to get to 4% before we talk about getting below 4%. And that getting to 4% might be the easy part. Getting below that's going to be the real difficult part. And so they just may have to be higher for longer. And that is not baked into the market at all.
So what should investors, Doug, do in this environment? Are there opportunities out there?
Yeah, so we went from a world of, the acronym TINA, which is there is no alternative, to stocks. Well, interest rates were 0 to 1%, and everybody backed up the truck for equities. And now you go to TARA, which is there are reasonable alternatives. And when you have 6-month treasuries over 5%, and you've got bonds at 6 to 7%, trading below their issue price, you could realistically have double-digit returns in the fixed income market over the next 12 to 18 months. So that puts some pressure on stocks that there are reasonable alternatives to investing. And so what we'd be looking for is some opportunities to enter into the market. I don't really see, with the market a little slightly overvalued right now, it's a little overvalued, this as a great entry point, unless you have a really long-term horizon. So you could go to the fixed income market for a little while and pick your spots if there is a little bit of a downturn, because the Fed has to raise a little bit longer and the market corrects.
What does this mean for bank stocks, Doug? I think about credit card rates at record highs, inflationary pressures persisting even on basic items, essentials, and basic services as well, like doctor's appointments, the dentist appointment, you name it.
Yeah, so I mean, in this, a lot of the services, I mean, you have a lot of growth there. On the bank stocks, I mean, they're going to benefit from rising interest rates because they're making the spread on what they're paying versus what they're making. So they're making more and more money there. But you have other issues where, I mean, credit card rates are absolutely astronomical. And I don't think people have really baked into how long it's going to take them to pay off some of the credit cards that they had that they thought they were going to. They did a great job with all the extra money that they had the last couple of years, but that's getting thinner and thinner, and it isn't too far along where you almost have a bifurcation of the economy, where the people that are doing okay will continue, but then you're going to have some people here and there start to really be impacted by a recession, that big R word if it comes. And it's not a horrible thing in the big picture, because recessions can be good to flesh out certain things, but it's certainly horrible if you're the person that's affected by it, if you lose your job and you can't make your payments. So that's the way that we see it right now. And it's going to take the better part of maybe the next 6 months to really figure out just where we are.
Yeah. All right, Doug Flynn, co-founder of Flynn Zito Capital Management. Doug, it's great to get your take today.